Companies buying into circular economy principles need to adopt new business models. In particular, this means moving from selling products to services. Implementing and scaling these circular business models requires significant financial investment. The interest and ability of different sources of finance to meet these investment needs varies. Currently, debt rather than equity is the primary source of finance. On the debt side, asset finance is the most popular and suitable source of finance. Banks' interest in the circular economy is increasing. However, their actual investments are still limited. As banks account for the majority share of debt finance generally, increasing bank finance for circular is crucial. In the future, bonds can also be an important financial instrument. However, accessing the bond market requires that circular businesses mature and scale up to meet the market requirements. On the equity side, there is interest and ability for crowdfunding to provide investment. A key benefit of crowdfunding is the ability to appreciate the environmental benefits of circular as well as the financial returns. Venture capital and private equity funds are important to access as they control much larger capital pools than crowdfunding. However, the requirements for high growth and relatively fast payback horizons can limit their suitability for some longer-term types of circular businesses. So what are the current barriers that limit these different potential sources of finance? One barrier is risk. The uncertainties around the residual resource value companies are able to capture from keeping product ownership under a circular model has emerged as investors' main concern. The lack of performance data available on the magnitude of risks restrict investors' ability to undertake robust risk analysis and therefore the willingness to invest. Another main barrier is communication. Mainstream investors are not familiar with the phrase circular economy and therefore do not understand circular's investment proposition. This can be addressed by emphasizing that many of the business principles circular models incorporate are not new and are aligned with trends investors are familiar with, such as the shift from product to services and dematerialization. Also, circular business models are associated with sustainability, which for many investors translates into them being less financially attractive. The sustainability association can be reduced by companies focusing on presenting purely the commercial benefits of the model when pitching to mainstream investors, mentioning the environmental benefits only after the commercial strength of the model has been well understood.